Good morning or good day and welcome to our next IFRS and Corporate Reporting webinar. Today we're looking at the interaction between financial statements and sustainability or ESG reports. So welcome to the session and we hope you find it very informative. Now, as always, I've got Kevin Frohbus, our IFRS and Corporate Reporting partner in Sydney, with us. Morning, Kevin.
Good morning, Aletta, and welcome everybody to the second session of the year. It's good to be back.
And then we also have a guest presenter. So Ashley Bleeker is a director focused on corporate reporting, sustainability, ESG, and he's based here in Melbourne. So Ashley, welcome to our IFRS and Corporate Reporting webinar.
Thanks very much, Aletta. Good to be here. I'm looking forward to it. And please go easy on me with the IFRS content.
All right, so fantastic. We thought we'll start and do a little bit of a recap of what we've discussed last month. And last month is not a month away. It was only 2 or 2.5 weeks ago. I think the 27th of January, we kicked off the new year here in Australia. And in that presentation, we looked at a board's perspective on, what's hot and what's not in 2020. But we've also looked at a finance team CFO perspective. I want to come back to that board perspective. And you will remember, that we've shared that BDO in the US did some research and did a survey of a number of entities and clients and asked, boards, what are you interested in, concerned about for the next year? And the key findings, they had 7 key areas. The first one was that engagement of shareholders and investors is priority number 1. We've got M&As is the top-ranked corporate strategy. We discussed cybersecurity, data privacy, how important that is for them around the governance aspects. On the right-hand side, we talk about the risk of supply chain disruption and how boards are thinking about diversification or sourcing diversification. On the bottom row, we talked about labor shortages, which we're all seeing, and how competitive it is to get talent, recruit talent, and keep talent. And then at the bottom in the middle, we've got ESG issues remain high on the board's priority list as directors explore options to how best comply with changing requirements and to communicate their efforts publicly. So ESG is squarely on the list of things that boards are worried about, thinking about for 2022. And then the last one, we had annual reporting, which was approaching in the US 31 December and for us approaching 30 June. And we know there's a lot of challenges around disclosures of risks and opportunities. So that's the findings we had from that survey, and we've discussed this at length last month. The one that we want to pick up this month is the one around ESG and ESG for near and long terms. So boards indicated that ESG remains a top priority for them. So there's a lot of new requirements. How do we comply with it? But I found it very interesting that boards are thinking about how do we communicate what we've done publicly? How do we communicate what we've done in the ESG and sustainability space to our stakeholders? And that's also what we are seeing in Australia. So quite often and very regularly, clients are coming to Ashley and I and saying, we're doing all these amazing things. ESG is important to us. Climate change is a priority. A net zero commitment is a priority. Or some of the social measures is a priority, or a number of these things. But people don't know it. So how do we communicate that? And how do we do it in the best way? And, do we require assurance on it? And, what's the roadmap to get there? So absolutely, this is what boards are worried about in Australia. I've also shared with you last time some deeper research which is talking about, the red would be a near-term priority. So let's say the next 12 to 18 months. A long-term priority would be the grey, and then 18 months to 3 years, and then absolutely no plans to implement in the next 3 years would be the maroon. So this is interesting. If you look at the first one, creating an ESG specific board committee, 65% said that's not going to happen in the next 3 years, which is interesting because so many of the clients we are speaking to are thinking about an ESG committee, or actually often embedding that ESG committee in the audit and risk committee, to be fair. In the second one, keeping up with evolving regulatory guidance to ensure compliance. Look there, 73% says that's a near-term priority. The third one, building a more diverse board and leadership team, and diversity, one of the key aspects of S in ESG, 55% want to work on a more diverse board. If you will say in the fourth one, right in the middle, aligning ESG reporting metrics with corporate strategy, 38% near term, that's a priority. Improving positive environmental impact, again, just a pure focus on environment, 28% in the next 18 months. And if you look at it collectively, about 70% within the next 3 years. Focusing on social issues, even more. We are looking at about 72% looking at social issues to be addressed in the next 3 years. And then finally, creating an internal ESG reporting framework, 44% is a near-term priority, and again 75% within the next 3 years. And this is research from the US, but what we are seeing in Australia. Ashley, I'm not sure if there's anything you wanted to add from all our discussions with our clients, other than saying I agree with this analysis and it's similar to what we are seeing.
Nothing further to add other than to say I agree with this analysis.
Okay, fantastic.
And the reason I say that is because there's an absolute commonality about some of this stuff. You know, this isn't just a small voice coming out of left field. There are very clear key themes emerging in this space. And at this level, these are absolutely the right themes to focus on. Obviously, things get interesting when you start, you know, delving further into this, which we'll do a little bit later. But absolutely, I agree with this.
All right, so you know, it aligns with our experience in Australia. We thought, with that in background, and we know boards are interested in this, and we know what happens. You know, finance teams are responsible for the preparation of financial statements, and they do that really well, and they deal with auditors very well. So we suspect the whole ESG sustainability reporting might become part of what the CFO and the finance team have to do very soon. You know, and how do we get processes and reports in place so we can get some level of assurance? So we thought, okay, let's go back and let's look at the current state and the current state in Australia. So how do financial statements, the normal financial statements, currently capture or refer to or disclose ESG performance? So what have we seen to date? And what we've seen is that we know there's an IIFRS practice statement too around making material judgments. And in that practice statement, it very specifically says that we have to look at qualitative external factors, for example, the industry in which we operate. We have to look at investor expectations. We have to look at the risks that impact the organization and whether it would be important, useful, relevant material to disclose those risks and their potential impact on the organization in financial statements. And they even say qualitative factors should be disclosed. It's not just quantifying the impact and that's it. So we need to think further than coming up with a quantitative impact and a quantitative disclosure only. And it's a clear statement saying we have to think about other risks and describe those risks. And one of the things they particularly say is, climate-related risks is a risk that's being faced by so many organizations. Although these organizations might not be able to quantify it as yet, they could include some description, some qualitative disclosure, so people are aware of it and not just ignoring it completely. So the first real reference material we should look at is the IIFRS practice statement number 2 around material judgments and disclosing those material judgments. The other thing that we're currently seeing in financial statements is IAS 1, which looks at the presentation of financial statements, specifically says that we need to disclose sources of estimation uncertainty, and we have to disclose significant judgments. Now, I've long held the belief that this note is actually the most important note in the set of financial statements. Traditionally, note 1, just after your financials, would be the accounting policies, and quite often they've been quite boilerplate. And we know we don't want it to be boilerplate, we want it to be tailored to the organization, but it's a difficult thing to do. The second note is often the one where we look at estimation uncertainty. What are the assumptions that we've made, and how would that assumptions impact our assets and liabilities over the next 12 months? And we disclose those assumptions, we disclose the potential impact, and people can therefore make this own adjustments before they make their decisions, investments decisions, and others. The other part is also significant judgments. If we've made certain judgments that are significant to the outcome, for example, whether we control another entity or not, if we've made a significant judgment on whether an asset is impaired or not, and it could be a significant judgment around a decommissioning obligation, maybe at the end of the period that we use a property, that we use a mine. All those judgments should be clearly disclosed, so people know the judgments that we've made, and if they think they would have made a different judgment, there's enough information for them to update the financials to apply their judgment. So to communicate to people, there's this accounting policies we've used, but also what was the estimation uncertainty? How would it impact our financials? What are the judgments we've made? How would that impact our financials? And you can see all of this really sits around sustainability in general. If we know there are certain climate-related risks, for example, that impact an organization, and we've factored it into our estimation, or we've applied our judgment in a certain way, i.e. it's impacting us or not, we should disclose that. Another one that is covered in IAS 1 is around going concern. If climate-related matters, as an example, create material uncertainties, around certain events or conditions, and we think that could lead to a potential problem for the entity to continue as a going concern, IAS 1 is very clear. We have to disclose those uncertainties. So I think one of the things that we've been talking about for years now is the need for us to extend the disclosures in financial statements beyond just numbers, but to embrace descriptive words, right, to address risks in financial statements.
Aletta, I have an example for you on this one. It never actually made it to the financials. Well, it hasn't made it yet because it's still currently in discussion, but it's a good demonstration of how this could apply to this particular requirement. So the entity concerned is heavily exposed to power prices, but also is currently exposed to the supply chain disruptions in global supply chain disruptions. So there were sort of two areas that actually are impacting their business model. They've entered into a power purchase agreement for solar energy to try and lock their solar pricing in. That part was probably more driven by pricing decisions more than saving the environment, but it presented an opportunity to kind of meet both sides of that coin. But at the same time, the supply chain disruptions meant that they had to start flying things in as opposed to their normal shipping routes. And there are a couple of people on the board who are climate or environmental focused, and so things like, you know, using aeroplanes and sort of emissions was a kind of a concern that they had about how that would factor. But that all flowed through eventually into sources of estimation, uncertainty, and judgments, because when they do their impairment modeling, and when they did their going concern assessment, they had to change the dollar figures in their cash flow assessments, because some of these things are costing more, but at the same time, the power purchase agreement was actually fixing their prices in, and they actually have discussed whether that's something that should be disclosed in this section of the financials, because not only is it information on an ESG level, but really it feeds into the numbers. Their impairment modeling, their going concern assessments, they're all influenced by these decisions. So it's a very good example of how this can apply to what's essentially just a very good business decision, you know, facing increasing prices, and it actually is linked to the ESG side of things. So there's a good example of how that, you know, can feed in, yeah.
And Kevin, I really like that example, because it could be that we're doing certain things that is maybe not good for the numbers, that will be reflected in the financial statements. But nowhere currently in the financial statements is there a need to disclose the fact, all right, the fact that the numbers are not looking good, but we are achieving other positive things. So it's that other side that's nowhere reflected in the financials. Unless it hits the numbers, it's not in the financial statements.
That's right, absolutely.
And your example is a good one, because it hits the financials, it impacts fixing the price, etc. So in a way, it's good. But what if it didn't hit the numbers? What do we do with it then? So I think that's the interesting bit. Thank you for that, Kevin. You know, another one is around inventories. You know, climate-related matters, and we're focusing here on climate related matters, because you would know globally, and even with COP26, a lot of focus on climate change, and the TCFD is talking about climate related disclosures. It could be that climate related matters can cause a company's inventory to become obsolete. It could mean that their prices fall, and or the cost to manufacture these goods could increase, right? Therefore, cost of inventories is no longer recoverable. You know, it's costing us a lot of money to get to these inventories. Kevin, maybe in your situation, very expensive to get the inventories to Australia, to import the inventories, and now you're flying them and not shipping them. So cost of inventories are increasing. However, maybe the market here in Australia is not willing to pay more, or not willing to pay that much more. And therefore, we are now thinking about, you know, should IS2 require us to consider the net realizable value of these inventories? And therefore, if I was writing down the value of my inventories, I think it's good to explain why I'm writing it down. That it's
And let I can go further with my example. This part was not discussed at the client level. This is me maybe just taking this example further right here in this webinar. Things like a temporary disruption to supply chain. There's a decision under your IAS2 inventory whether that actually is an abnormal waste and is expensed, or whether that actually starts to feed into your standard costing and your absorption costing. You know, so that's a very real example of even just not even an ESG issue, just a practical problem right now with global shipping problems, is whether any increases there are abnormal, in which case you expense, or whether you actually have to adjust standard costing. And but taking it through to the power purchase arrangement, you know, you're fixing your power cost for a certain period. Well, that also bears on your standard costing from an inventory point of view. So before you even get to NRV, you actually have to get through costing, you know, the actual cost of the inventory in terms of absorption pricing. And that's a great example of just good old fashioned accounting under inventory standard.
Yeah, absolutely. And I mean, people would be looking at financial statements and they see a significant decrease in the margin that we're making on our inventories, and say, so what's going on here? You've gone from this margin to this margin. what's happening, and we can say, listen, it's because of XYZ, because of shipping. We can pinpoint the reason for it, and it explains the variance, and it can explain that information to the users. Another one is around income taxes. Now, the one around income taxes is interesting because, again, we use the example of climate-related matters, but it could be other sustainability matters. Could have an impact on the company's estimate of future taxable profits. So we know due to climate change, there's a significant, let's say, decrease in future taxable profits for a particular client. And therefore, they can no longer recognize deferred tax assets. So previously, they thought they will have the future taxable profits to get those tax deductions against future profits. Now they no longer have it. Maybe they have to de-recognize deferred tax assets, which could be a problem. So I think that, even climate-related matters even pulls through to deferred tax assets, right? And when I thought about this, I thought that's a bit scary. And I know it's so hard to book a deferred tax asset. There's so many hoops to jump and to convince that you've got a projection that, listen, I've got this assessed loss, but sometime in future I'll be able to use it because we are predicting profits in future. Maybe that is now pushing out. Maybe it's not probable anymore. So again, think about your deferred tax assets and whether you'll still be able to recognize them. I think the one that we often talk about, and maybe a very obvious one, is the impact on property, plant and equipment and intangible assets. So, if we've got our business assets, our property, plant and equipment, or even our intangible assets, we know we had to estimate an expected useful life. We would depreciate them over that expected useful life. Usually we would think about what is an expected residual value at the end of their useful life. Maybe due to climate change, we now have a problem that our property, plant and equipment only have a 2-year expected useful life, because due to the new legislation, we would no longer be able to use it due to emissions. Maybe we've got certain a plant that, or projects that there's now an increase in a decommissioning liability. So there's so many potential impacts on property, plant and equipment and intangible assets, depreciation, amortization that might be fast-tracked. And it could lead from obsolescence. It could lead from legal restrictions. It could be that we can no longer reliably estimate residual values. It could be that we're not 100% sure about expected useful lives. So again, quite a problem when we think about property, plant and equipment and intangible assets. Impairment of assets, obviously, a good one. We've said to entities for so long, you should look at your assets very critically and see whether the cash generating units or the individual assets still will have the ability to generate cash flows in future that exceed their carrying amounts. So if we are thinking, that in future we would not be able to use it, or that it's going to be very expensive to use it, we'll have to start to think about impairing these assets. So this is a real thing for many organizations, critically looking at their balance sheets, critically looking at assets and thinking whether we'll be able to recover and get the benefits of these assets over time as organizations are forced to pivot to new technology. Then we also have provisions. So this is on the credit side of our balance sheet. If there's new legislation that we have to repair properties where we move out, or mines that we move out, or we have to repair, do additional activities in the environment, again, we need to create a provision for that. I'm thinking on provisions, the good old example, if you're in oil and gas and you construct a new oil rig and you cause damage to the environment, and you have to fix that, create a provision as soon as you cause the damage. So to think about that carefully. Financial instruments. Now, this is an interesting one. you know, IFRS 9 in particular require disclosure of information about financial instruments, including the nature and extent of risks arising from those instruments, and also information on how an organization manages that risk. So, you know, climate-related risks climate-related matters may expose the organization's financial instruments to increased risk, and we have to think how we're going to manage that. So it could be that we've got a concentration of credit risk around lenders. It could be around expected credit losses around our receivables. So we have to think very carefully. Maybe our customers are impacted by climate change, and therefore we've got an ECL impact. Maybe our lenders are impacted. So, you know, it's broader than just us. It's the whole ecosystem, our suppliers and also our customers, and where do we get our finance from? We can extend this to IFRS 9 around financial instruments and similar considerations. You know, if we're a lender and we're exposed to credit risk, and if our borrowers are impacted by climate change, you know, bushfires, floods, etc., that would impact their ability to pay us, and that impacts all the disclosures and how we manage the risk around our financial instruments. Fair value measurement. So this kind of there's a link with impairment of assets. So if you are stating your assets at fair value, you know, are you happy with your fair value measurement for these assets? And how do these new risks impact the fair value of your assets? Remember, when we look at fair value, it's a market participant's view on the value of an asset. And if there's a perceived or a real climate-related risk, it would impact the market's view about the fair value of your assets. So how do you factor that in? I think, which is another one. And then obviously insurance contract, if you're in the insurance space, if you've got insurance contracts, climate-related matters may increase the frequency or the magnitude of insured events, or it might even accelerate the occurrence of those events. So you can see, as we step through all these accounting standards, there's already touch points with climate related issues and other sustainability issues with our financial statements. But in a way, it's kind of as if climate related risks and sustainability risks seem to have a negative impact on our financial statements, or potential negative impact on our financial statements. It's all about risks and how do we manage risk. The other thing that we know is that the task force on climate-related financial disclosures has been established, and I've put a link in there. And they've specifically said climate change presents financial risk to the global economy. They believe financial markets have to be informed. They think there should be a consistent mechanism how organizations disclose the impact on the organization so that we can have comparability in financial markets. So I've put in a reference to that. I've also put in a link to the recommendations that they've put in place. So I know organizations have widely adopted these TCFD recommendations, and you haven't done so yet. I think it's a good idea to consider these for your 30 June 2022 financial statements. So in this first part, what I've tried to establish is that to date, climate and other sustainability ESG aspects have appeared and have linked with financial statements in a somewhat limited way, and usually in a somewhat negative way. It would decrease fair value, it would decrease value of inventory, it would lead to an impairment of assets, it could increase a provision. What we are thinking is, you know, there has to be balanced communication and not just the downside of what sustainability or ESG mean for an organization. So I think what's important here is also to think about the expanding of the users of financial statements. If we look at the Conceptual Framework, which was revised and updated in May 2019, and it talks about, general purpose financials and the objective of general purpose financials, it talks about providing financial information about the entity that is useful to existing and potential investors, so shareholders, and it's useful to lenders and other creditors in making informed, confident decisions when choosing to provide resources to the entity. So before I invest in the entity, before I provide a loan to the entity, before I provide my financing, let's look at the information that they need. So the primary users of these general purpose financial statements are existing and potential investors and lenders and other creditors. So it's a very narrow scope of users. So whenever a standard setter is preparing an accounting standard, they are thinking about these users. Would investors want to see this information? Would lenders and creditors want to see this information? However, what Ashley and I are seeing is that organizations have more stakeholders that want information from the organization. So it's not just the investors and the lenders. Yes, they want information, but we know employees want information about an organization. We know contractors, unions want information. We know that government want information. We know the ASX, ASIC, our regulator, want information. We also know that the local traders, the broader community in which we operate, want information about the organization. So an entity cannot operate in isolation and just think about our investors and our financiers. An entity is operating within an environment, in a community. They have employees, they've got clients, they've got customers, they want to sell their goods, and all of these people are interested in the organization. I'm just thinking in my own house, the young people in my house want to know that they buy from an organization that is responsible with how they treat the waste. They want to know that they're not hurting animals, and they've not tested products on animals, right? So more and more, an organization cannot just say, give me more money and this is the information to get more money. It is, how do I get people to work here? How do I get employees to work? How do I get customers? So definitely,
sorry,
Ashley.
Maybe I'll give you a break for a minute.
Yes, please.
I think from a reporting risk as well, one thing that I don't think many people have considered is supply chain. And the reason that I say that is because everyone is becoming under increasing pressure at the moment to demonstrate their performance in this regard if they're not the big cat in the supply chain, right? So what do I mean by that? So the basic example is if you're a supplier to Coles or Woolworths might turn off your supply contract if you can't demonstrate your ESG performance to them. Now, that's clearly a material revenue risk. However, and that's a fairly clear example, but there are plenty of organisations out there for whom government is a significant client. And a lot of the professional services firms have government or government agencies as significant clients, or even the banks, and government and the banks and other big organisations are turning around now and saying, demonstrate your ESG performance to us. And if you can't, to their satisfaction, you'll either get kicked off a panel or you won't get any more work. But that is clearly a revenue risk, because if government is a massive client of yours and your revenue dries up almost instantly because you kicked off a panel, what do you do about it? And so this isn't just theoretical anymore. This is absolutely clearly material, and that's obviously just one example. That's just supply chain, and that's just if one of your key clients or key customers decides to terminate your services for whatever reason.
Absolutely. Thank you, Ashley. So I think what we're trying to put in context here is the primary users or the historical users of financial statements which are just the investors and the lenders, right? They were interested in information that helped them with decisions around buying or selling or holding their debt or their equity, or providing loans, or exercising their rights to vote or influence other decisions that would impact the entity's economic resources. And the conceptual framework is actually very clear. It specifically states that general purpose financial statements do not and cannot provide all the information that existing and potential investors, lenders, and other creditors need to confidently make these critical decisions. So although they are our primary users and we try and give them all the necessary information, we are very clear that we do not and cannot give them all the information, not even our primary users. So we cannot give them information around general economic conditions and expectations, political events and political climate, industry and company outlooks, right? So that's not what financial statements do. It's just one part of the puzzle is what you see in financial statements, and that is if you're a primary user and the financials are prepared for your purpose. So I think the important thing is the mandatory communication of general purpose financial statements is only directed at some of the information needs of the primary users, not all of it. And I think the other thing that we're trying to articulate is there's primary users and there's all these other users. For the primary users, we're not giving them all the information they need. And for these other users, we're definitely not giving them appropriate information in normal financial statements. And therefore, we are saying, if an organization want to prosper in the new world around ESG, around sustainability, and if they want to deal with all these stakeholders, if they want to attract and retain talent, employees, if they want to be able to keep their customers, they will have to communicate more to their stakeholders than what they're currently doing. And we believe the way to do that is in a sustainability report or in an ESG report. So audit and risk committees need to take an interest, and they need to understand and assess the business risk and the business impact of ESG risks. But I think it's also important that audit and risk committees understand the opportunities associated with proper and good ESG sustainability communication, because it's not just risk, there's opportunities too. We know that the whole ESG is or the whole business problem is around access for organizations to capital, access to markets, and access to people. And financial statements basically address access to capital. And we need something more to address access to markets and access to people. Ashley, anything you wanted to add on this one?
No, I think that's just a very clear expression of, well, we've tried to clearly express what's forcing the issue here. And so the idea is to keep that very simple as a starting point.
And I think for us, looking at this and working with businesses, we need a holistic approach. We need to communicate to all our stakeholders, not just primary users. And in order to communicate with all our stakeholders and in order to address reporting risk and business risk, we believe this holistic or integrated approach consists of two parts. So it's financial statements that's prepared in accordance with Australian or international accounting standards, which are usually audited. And then on the right-hand side, the need to start to voluntarily prepare ESG or sustainability reports to supplement the traditional financial statements. Interestingly, Ashley, we're starting to get requests where entities have prepared ESG and sustainability reports for a number of years, and they realize, it looks a little bit odd, our financial statements are being audited, reasonable assurance, high level of scrutiny. But this other document, this ESG or sustainability report, which provides important information to so many stakeholders, there's no level of assurance over that. And so people are starting to say, can you help us? We need assurance also over this report. And it's also a journey. Maybe it's initially just assurance over aspects and we increase it over time. But I think we'll need to get to a stage where the two reports sit next to each other and both have some level of assurance in order to have a credible communication to the market and on all stakeholders.
Aletta, would this be a good time to do a quick straw poll of our listeners and see where everyone's at in this process?
That would be amazing, Ashley. Thank you for reminding me, because I get a little bit overexcited.
I do.
So there's the first one.
So I think the last option there is probably missing some words. It should say has produced one or more sustainability reports and provided assurance over those reports.
Yeah, Ashley, that's my mistake. I didn't realize the last words were cut off. So the very last one is you're already doing a sustainability report and you've got assurance over it, which is quite amazing. Well done. While you complete that, I'll give you a bit of time to think about that. I think for us, the key thing is more and more we are seeing that traditional financial statements prepared to those traditional primary users, which are amazing and which are audited, is not doing justice to all the great work that the organization is doing. And many clients that we speak to, they actually do a lot of things around their social impact, around diversity, around privacy, around climate change, but it's not disclosed in one central spot. So I think the time has come to address that. All right, thank you very much for all of you that's participated. I'll close that one and I'll share. You might, Ashley, you might or might not find it surprising. So at the moment, we're seeing 55% have not started yet, 18% working on their first one, 19% have done more than one already, and 7% even have assurance. All right, so that's actually quite well done. Very interesting.
I'm surprised. I actually thought it would have been more skewed towards not yet than that. So that's a great outcome, I think.
All right, so the 55% you think is a bit lower than you expected, Ashley?
Yeah, I would have expected that to be more, just based on, a lot of the, I suppose, conversations we've been having recently. So it's great that what have we got? Almost, 50% have either started it or have produced something.
Yeah, fantastic.
I'm with Ashley on this one. That was where I was in my mind, Aletta.
Yeah, so you also thought the 55% is quite low.
Yeah, it's very encouraging.
Yeah, no, fantastic. So I suppose just to summarize our holistic approach, we firmly believe that if organizations are to prosper in this new reality, where ESG matters to multiple stakeholders for multiple reasons, this has to be communicated, and entities have to communicate their ESG impact to all, communicate it to all stakeholders to illustrate how the organization creates value for all stakeholders and is therefore a sustainable organization. So I think a lot of people might have been looking at sustainability reporting, ESG reporting with a negative lens, and it's because it usually had a negative impact on the numbers. And we are saying, let's bring back the balance. And we know this is important. We know there's good stories to tell. Let's bring the balance and put it in a comprehensive, holistic communication. and potentially supplement financial statements with a sustainability report. Now you might ask, so what are the reporting frameworks? How do I know what to disclose? Where do I get the guidance for that? So the sustainability reporting frameworks are at this stage still in its, dare I say, infancy. It takes me back about 20, 30 years ago, where when you looked at accounting standards, there were so many frameworks across the world, every country doing their own thing, no consistency. So at the moment, from a sustainability reporting framework perspective, we've got more than 500 possible reporting frameworks. Every organization has different stakeholders. They've got unique issues. We've got all these reporting frameworks. So it's very difficult to do a comparison. Some of the frameworks that we see a lot of, the United Nations Sustainability Development Goals, the colorful one, the 17 goals, you see quite a lot in financial statements. I personally like that quite a lot, maybe because I like colors and picture. The World Economic Forum is very cool. They've actually taken the United Nations 17 goals and grouped it into 4 pillars around principles of governance, which has to be the starting point of what we do, around planet, people, and prosperity, which is really powerful. Then there's, the Value Reporting Foundation that's issued the SASB standards. I've already spoke about the TCFD, the Task Force for Climate-Related Financial Disclosures. And we know there are the GRI disclosures and reporting guide. To just mention a few. Now, the one that's getting me excited as a real nerd is the IIFRS Foundation. So at COP26 last year in November, they announced the establishment of a new International Sustainability Standards Board, the ISSB. Now, the exciting thing about it is that the ISSB is trying to do for sustainability reporting what the IASB, International Accounting Standards Board, have done for the harmonization of accounting standards. So the way at the moment, we all follow IFRS. Australia follows IFRS. Most of the world follow IFRS, with the exception of the US. The ISSB is trying to do the same. So they're sitting within the same foundation. And the reason they're in the same foundation is they are saying there's this link between accounting standards and sustainability reports. And we've talked about that link in this webinar today. So there's a link. We want these boards to work together to get to holistic communication to stakeholders. So let's put it in one place. They've also said they've done this because they acknowledge that finance professionals who look after accounting standards will also be looking after these sustainability disclosure standards, dealing with auditors or assurance providers. So I think they're trying to bring this within the domain of finance teams. Because quite often the people running with sustainability is a separate sustainability team in an organization. But in order to communicate to stakeholders, we need to bring it to a central spot where we put in systems and processes to measure and report and withstand audit. You can see they already have consolidated some of the previous standard setters into the ISSB. So it's a really exciting development. The other thing to note is the TCFD disclosures have already been incorporated into the first prototype standards that the ISSB has been issuing. So they've actually tried very hard to get some of the other big players involved to establish a body to move to one central set of reporting standards, and they'll also be issuing IFRSs. So here's some information around the prototype standards they've issued. There are general requirements similar to what we have in accounting standards, like an IAS 1 equivalent, where they talk about, and I found this interesting, you have to disclose your risks and opportunities. So if you look on the left-hand side, the second little triangle, it talks about complete, neutral and accurate disclosures about significant sustainability risks and opportunities. Not just the risks in the financials, but also the opportunities. And then also your governance around it, your strategy around it, your risk management, and also how that is supported by metrics and targets. And then they have, I think, aligned with globally, although there's a lot of aspects to ESG and sustainability, the one that's really top of mind for many people is climate. And therefore, they've started then with a specific standard on climate. And there's a prototype standard, prototype disclosures. The prototype disclosures, 581 pages, looking at different industries. Ashley, I think it, yes.
I'm sorry to interrupt you again. I wonder just whether we could stretch the friendship with our listeners and do another quick poll. We've talked about different frameworks there, and 50%, well, almost 50% of listeners have started their journey. Could we get a sense of what frameworks they're using to provide their ESG reporting under? So here we've added in a couple of the main ones. So the United Nations Sustainable Development Goals, the World Economic Forum 4 pillars, the Task Force on Climate-Related Financial Disclosures, the Value Reporting Foundation, or the SASB, which is ultimately folding into the ISSB anyway. It'd be good just to know what frameworks people are using in this space.
Yes, Ashley, that will be really interesting to see. Or if you haven't started the process, which are the ones you're currently thinking about, or based on your information, the ones that you're most inclined to do. It's an interesting process to pick an appropriate one, but that would be really interesting information. Thank you very much for sharing.
And you're conflicted because you like the coloured boxes of the SDGs, but the IFRS nerd in you wants the ISSB protocol.
Yes. Yeah, so I'm, it's kind of, is it heart versus mind that's fighting here, right?
Yeah.
Absolutely. All right, so we'll close that one and we'll share that one. So interesting. I'm hoping you can see it, yes. So Ashley, I could only have 5 alternatives on the poll question. So a lot of people are in the other bucket, so that would be interesting to know exactly what they use. So if you wanted to put it in the chat box, that would be very interesting for us, what actually you use. But then 22% like the pretty boxes like me, 23% the TCFDs, World Economic only 10%, which is interesting. And actually, we thought the SASBs have a bigger following. Maybe that's just in natural resources.
Yeah.
I think that's where we've seen it a lot in that. Yeah.
Emissions intensive industries tend to favour or have historically favoured that.
Yeah. Maybe why we've seen it in resources. Ashley, I'll hand over to you to talk about net zero, because that's the buzzword after COP26. Net zero by when?
Sure. Thank you, Aletta. So I suppose this is just a quick conversation. And all this is an example of one issue in one space in the ESG ecosystem, right? So you've got E, you've got S, you've got G, and in E, a lot of people are talking about net zero, right? And so net zero really just means reducing your greenhouse gas emissions to zero by doing certain things. And so we just wanted to share this by way of example, because we suspect this is either relevant for you right now or will be relevant for you at some point in the future. Because as far as we can tell, every organisation is either talking about an emissions reduction strategy or they're talking about an emissions reduction to the point of net zero strategy. So there's no real there's no real mystique to this, but the TCFDs prescribe effectively a 4-part plan on how to put in place an effective carbon reduction strategy. And it's like most things that you would see in around risk management, governance frameworks anyway. But the key parts to it involve being able to actually articulate what it is you're trying to do. So what's your strategy in this space? and being able to integrate that with other business plans across your business and being able to communicate it effectively to all stakeholders, internal and external. Putting in place the right level of governance around the program. What role does the board play in it? What role do other organisations or other bodies within the organisation play? Are the roles and responsibilities clearly documented, and are the policies and procedures supporting that clearly documented as well? What's the kind of risk management framework that you wrap around that? Have you got an easy way to continuously identify and assess carbon reduction risk? And if so, what are you doing about that, and how are you monitoring it? And then, of course, there's the measurement, because without the measurement, you don't know how well you're tracking against any carbon reduction strategy. And so, have you got clear targets in this space? Have you got consistent and reliable mechanisms for measuring your performance? And are you communicating your performance effectively to your stakeholders? So again, nothing surprising in that framework, but that's kind of considered to be the standard framework you'd put in place for any kind of net zero or carbon reduction strategy. Next slide, Aletta, please. So allied to that is this whole idea of a carbon mitigation hierarchy. So unfortunately, not all things are created equal in the context of carbon reduction. And a lot of people are talking about buying offsets to effectively offset their carbon footprint. And you can see here, we've got this upside down triangle of hierarchy where we look at it in the context of avoid, reduce, restore, and offset. And unsurprisingly, the best way to reduce or avoid emissions is to just get rid of them altogether. And so identifying activities within your business that create emissions and working out ways to stop them is a really effective way to do that. The great thing about this is that it usually involves avoiding cost. And so it tends to be incredibly cost effective, as well as a great way to improve or to execute your carbon carbon reduction strategy. So that's a really important one. The next one obviously then is reduction. So how do you make activities less emissions intensive? Can you introduce more efficient technologies? Can you upgrade to more modern processes? So electrification is a huge focus for many industries at the moment, including transport, obviously. And so there's a real focus there on being smarter about how we do these things. Restore, how do we replace emissions by transitioning to renewable energy sources? Do we buy renewable power? Do we look at technology improvements? So how do we, replace traditional mechanisms here? The classic is the electric vehicle. Many people are driving around in Teslas, but while that's interesting from a consumer perspective, many organisations with large transport logistics footprints are investing in fleets of electric trucks, and that is a massive game changer when you consider that all of those vehicles currently run on diesel, which has a huge emissions footprint. And then the last bit is this: once you've done all of those things within your business and you've still got a residual footprint, what do you do about your residual footprint? You buy offsets that match your residual footprint, which is a great idea. The challenge we have in Australia at the moment, though, is we have a real market asymmetry around purchasing carbon offsets. So they're called Australian Carbon Credit Units, ACCUs. And at the moment, the price of carbon credits in Australia has more than tripled in the last 12 months. So last January, they were $15 a tonne. Now they're in excess of $45 a tonne. And the main reason is because everyone is committing to these net zero targets or reduction targets. And part of their strategy is that they'll just buy offsets to deal with the difference or the residual. But people aren't generating offsets to the same extent that others are committing to purchasing them. So the forward trend for this is that the price of these offsets is just going to increase dramatically because Australia is not able to produce enough accredited offsets to meet the demand that's coming down the pipe. Now, that means that organisations will look externally for these types of offsets. The offsets are cheaper overseas, but the accreditation programs are far less rigorous. And while people might think that's a good stopgap, most of the stakeholders that will hold organisations accountable in this space are very aware of the fact that international offsets often don't carry with it the same level of responsibility that Australian offsets do. So that's just one example of one of the many issues that are facing organisations when they're reporting on ESG issues. Aletta, I wonder if we should just, I'm conscious of time, should we do our final poll quickly and just see, is this an issue that's affecting your organisation, or similarly, are there any other issues affecting your organisation? Now, we've just added in a few, but there's a stack of them, but it could be net zero, it could be waste. Waste is a massive issue. And then in the S space, not the E space, diversity and inclusion around your staff and your workforce is a big issue. And also community engagement can be a big issue as well. So we'd just be curious to know whether you think one of these issues is affecting your organisation more than others.
And then again, if it's an other issue, you are more than welcome to put it in the chat box. You know, we are very interested to hear what's going out there in the market. We're speaking to a lot of clients, but always good to test our thoughts with what our regular attendees are telling us. So thank you very much for participating. So many people are voting or sharing their ideas. We really appreciate it. All right, so I'll share it. Should be showing very soon.
Yeah, well, that's good. I mean, that shows that all four of those are incredibly important to a lot of organisations.
Absolutely. So thank you very much, Ashley, for talking through the net zero. We've reached the end of the hour, and therefore the question, so where do you start? This is a big process. If you want to work towards holistic communication for your 30 June financial year, we're proposing financial statements as well as a complementary or accompanying, I should say, sustainability report. And we know that
showing the polling results, do you need to flick screens?
Oh, sorry, that's now I just have to hide it. That will help. I'm hoping you can see it now. So thank you for that, Ashley. So where do you start? You know, it's a long journey. And, you know, to get to a place of financial statements and accompanying a sustainability report will take a bit of time. We know there's a lot of people very interested in it, and it's a real race to get all the information. So what we've scheduled is similar to these monthly IFRS and corporate reporting webinars. We're going to schedule our inaugural 2022 ESG webinar series. We're starting with a series of 6. You can just hold your phone up to that nice QR code, and you can go to the page, or you can click on the link, and you can register for our webinars. So it's sustainability ESG webinars that Ashley and I will be presenting. On the 16th of March, we start with demystifying the whole process. Then we look at frameworks, stakeholder engagement, you know, how we measure to manage this, pulling it all together in July so we can issue a report in September, October. And then we also discuss with some of our assurance partners, you know, how do we do assurance over an ESG report? So the whole process, a series of 6. Ashley and I have also invited a number of other partners across BDO Australia to join us. So we'll have some of our friends from Perth, from Brisbane, from Sydney to share what they're helping clients with and give you some tips on the way. So if you want to register for those, it would be great. Also, if you are interested or your company is interested, but maybe you're not the person, maybe there's a sustainability team, that would be great. I actually think it would be really good if boards, finance teams, sustainability teams can watch this together and afterwards contrast and compare and make some notes on next steps. I think it's really clear that often in organizations it can be a bit disjointed, but you know, Audit and Risk Committee, are you on top of it? Finance team, are you on top of it? Sustainability team, are you on your own, or are you working with the board and the finance team to progress this forward? So please register for these webinars. It would be lovely if you could join us. If you need assistance, as always, whether it's IFRS corporate reporting or sustainability, please feel free to contact us. You can register for our webinars for the rest of the year. Next month, we'll be talking about the new IFRS 17 on insurance contracts. It's not just for insurers, and there can be insurance elements in many contracts, so it's an important webinar. And then we also have a request, please register for our financial reporting insights that are issued every month. It is now been rebranded. It was previously Accounting News, but we are all of you, all of us are much more than accountants. So it's all about financial reporting insights, business problems that we want to share, sustainability. And if you want to speak to any of our IFRS corporate reporting leaders, please reach out. And obviously the broader team, you can see Ashley and I are a little bit green because we spend so much time on sustainability and ESG, but please feel free to reach out on any matter and we're happy to speak to you and help you. I'll end off by saying, Kevin, Ashley, thank you very much for joining me. Always lovely to have you. And for everybody that's attended, you're welcome. Thank you for everybody that's attended. We'll see you again next month. And, you know, shout out if you want to talk about sustainability.
Thanks,
Bye,
Aletta.
everybody. Have a good day. Bye.
Thank you.